Hi, and thank you for joining us again. My name is Michael Kielenniva. I'm a corporate tax specialist here at RSM in Brisbane. I'm joined by Carney, a specialist from our indirect tax division. In the last few episodes, we covered 3 of the 7 principles of effective tax governance: being accountable, management and oversight, recognising tax issues and risks, and seeking advice. Today, we'll be covering Principle 4, integrity in reporting. Louis, are you happy to kick us off?
Absolutely. Thanks, Mike. The focus of this principle is to ensure the financial records of businesses are true and fair. When considering whether this principle is satisfied, the ATO will want to find comfort that businesses have systems and controls in place to ensure accurate reporting, and that these controls are reviewed periodically to ensure they are operating effectively. This could include incorporating documented processes to monitor and explain significant differences between income years, ensure effective record keeping, ensure tax calculations are subject to an adequate review process, or implement processes to ensure the accuracy of the underlying data used in preparing the tax lodgements. I would like to emphasize that it is not enough just to have the procedures in place. You will also need to demonstrate to the ATO that the tax governance framework is operating effectively within the business. In other words, that it is lived in practice. This in turn demonstrates to the ATO that the information being reported has undergone the necessary reviews and checks to ensure it is true and fair. Mike, what can taxpayers do to demonstrate this to the ATO?
So, when assessing whether businesses meet this principle, the ATO want to see objective evidence that the tax governance framework in place is designed effectively and operating effectively within the business. Design effectiveness can be demonstrated by performing what we call a gap analysis. So in performing this analysis, we would conduct a review of a company's existing tax governance framework and assess it against the ATO's published best practice guidelines. In doing so, we effectively identify gaps in the business's tax governance framework, which we would then include in our findings report. So this finding report would then be the objective evidence that can be provided to the ATO to demonstrate that the framework is tailored specifically for the business. Louis, did you want to cover how businesses would demonstrate operational effectiveness?
Thanks, Mike. For businesses to demonstrate that their tax governance framework is operating effectively, the ATO would want to see evidence that the controls and procedures in place have been tested. This is done through a third-party control testing exercise, for example, walkthroughs. Embedded into any tax governance framework are usually key controls to ensure risks are mitigated. These controls can include a thorough review process, the use of external advisors, or internal checklists. A control testing exercise is essentially an internal audit of the controls a business has implemented to ensure they are working as intended. Generally, after a control testing exercise is conducted, a report is provided that details the controls that are working effectively, along with any controls that may be deficient. This report can then be provided to the ATO as objective evidence that the tax governance framework in place is being lived within the business and is undergoing constant scrutiny. There is much more to canvass with regard to the details of this principle. However, this is all we can cover in this segment. Please reach out to either of us over LinkedIn if you have any questions at all.
Thank you. Have a great week.
Thank you.